Welcome, I'm the Options Overlord, and this is how to trade the long put. When you expect a stock to fall, this is how you position for it, with leverage and with your risk defined before you ever enter. We do this the disciplined way: education first, risk defined always. Let us get to work. First, the ground rules. Everything here is general education, not personalized financial advice. Options carry substantial risk. They are not for everyone, and you can lose money. The numbers in my examples are illustrative, chosen to teach, not forecasts. Do your own research, speak to a licensed advisor, and own your decisions. Good, now let us trade. So what is a long put? You buy the right, but not the obligation, to sell 100 shares of a stock at a set strike price any time before expiration. You pay a debit up front, and that debit plus fees is your maximum loss on the option. All else equal, the put gains value as the stock falls, and at expiration it profits below break even. Three things make this work. Your maximum loss is defined. Buying the put needs no margin, though exercising it later can create a stock position that does. Your upside is large and defined, growing dollar for dollar below break even. And it is capital efficient, leveraged bearish exposure with a defined debit, and none of the unlimited loss risk of shorting the stock. Here is the mechanic, 4 steps. 1. Pick your stock and direction, a stock or exchange traded fund, an ETF, that you are bearish on, ideally breaking below support. And make sure the options themselves are liquid, tight spreads, real volume and open interest, and always use limit orders. 2. Buy the put. Our preferred setup: in the money put, delta minus 0.6 to minus 0.75, 60 to 90 days to expiry. Now that minus sign matters, so let me be clear. It simply means the put moves opposite the stock. All else equal, a minus 0.60 delta means that when the stock falls $1, the put gains about 60 cents, and delta itself shifts as the stock moves. The debit you pay is your maximum loss. 3. Let delta work. The put gains as the stock falls, and at expiration, every dollar below break even adds $100 per contract. 4. Sell to close. Exit before expiration. Lock in the gain and keep any remaining time value. Winners get sold, not held. Let us make it real. XYZ is trading at $150. And you are bearish. You buy the $155 put in the money, 60 days out for $8. That is $800 paid today, the initial debit, and with fees added, it is the most you can lose on the option. Your break even is $147, the strike minus the premium. Below that, every dollar of decline is $100 in your pocket, all the way to a maximum profit of $14,700 if the stock somehow went to zero. Illustrative, not a forecast, but that is the shape of the trade. Defined risk, open downside capture. Look at the payoff and let it sit on the screen. Below $147, you are in the profit zone. $100 per contract for every dollar of decline. At $125, that put is worth $3,000, a net profit of $2,200 against the $800 you paid. Your break-even is $147, the $155 strike minus the $8 premium. Between $147 and $155, you give back part of the debit, and at or above $155, the put expires worthless. You lose the $800 debit plus fees and nothing more. That cap is the whole argument for buying puts instead of shorting stock. At expiration, results land in one of two broad zones. Either the stock falls below break-even, say to $135, your $155 put is worth $20, $2,000 total, and you sell to close for a $1,200 profit. That is 150% on the $800 at risk. And before expiry, you sell to close while time value may remain. Or the stock stalls or rallies. Theta eats the premium every day. At $150, the put is worth $5 only. And at or above $155, it expires worthless. Max loss, the $800 debit plus fees. Cut losers early, and as our rule goes, do not hold to expiry hoping. So when do you reach for this? Everything on this slide is about the standalone bearish trade. When you hold a genuine high conviction bearish view, direction, magnitude, and timing, all three. And one boundary before we go on. A put bought against shares you already own is a protected put, a combined position with its own payoff, and that is a separate discussion. When IV rank, implied volatility measured against its own recent range, sits below 30, you pay a lower volatility premium, though a low rank never guarantees the option is cheap. When the chart confirms it, a break below major support or the 200-day average. When you can buy 60 to 90 days of time, not lottery tickets. And for speculative entries, when no earnings or other binary event sits inside the window. Protecting through an event is a hedging decision, not this trade. Tick those boxes and the long put earns its place. Now the risks, and I want you disciplined here. 1. Your max loss is the debit plus fees. That is the gift of this structure. But hear this clearly, defined risk is not automatically small risk. Size the position so a total loss of the debit fits your risk budget. And one mechanic worth knowing, as the holder you cannot be assigned, but an in-the-money put held through expiration may be automatically exercised unless you instruct your broker in time. Our normal exit is simply to sell to close, well before that ever matters. 2. Theta works against you. All else equal, the put bleeds time value every single day, and the bleed generally accelerates near expiry, most sharply for options near the money. The stock has to fall faster than the clock. 3. Volatility cuts both ways. Buy into rich implied volatility, and a vol crush can sink the put even while the stock falls. Above IV rank 50, use a spread or wait. 4. 3 things must be right: direction, magnitude, and timing, and getting only 2 of them right can still produce a loss. Set your exits before entry, and remember tax treatment varies, so get local advice. 6 best practices. Buy 60 to 90 day expirations. Time to be right and slower decay, because decay punishes short-dated puts hardest. Buy in the money, delta minus 0.60 to minus 0.75. More intrinsic value and a stronger directional response than at the money or out of the money puts, with less theta drag. Enter in low volatility, IV rank below 30. A lower volatility premium relative to its range, and relative is the word. It is not proof the option is cheap. Take profits. Our rule at 30 to 50%. Fast winners get sold. The stock owes you nothing further. Stop losses at 50% of premium. If the put halves, close it and preserve the capital for a better setup. And never buy a binary event, earnings, Fed days, FDA decisions. The post-event volatility crush can beat you even when your directional call was correct. Those 6 rules are most of the game. Let us go a level deeper. 2 dials decide every long put, delta and implied volatility. Delta first. It is how far the put moves per $1 of stock, negative for puts, and its size is a rough proxy for the probability of finishing in the money, not a forecast. Minus 0.10 to minus 0.20 is the lottery ticket zone. Cheap and low odds, avoid it. Minus 0.40 to minus 0.50 is at the money, mostly extrinsic value, decaying fast. Minus 0.60 to minus 0.75 is the Overlord sweet spot, in the money, a strong directional response. And minus 0.80 and deeper gets expensive, with capital better used in a spread. On volatility, you are a buyer, so you want the volatility premium low. IV rank below 30 is the buy zone, low versus its own range. Though low rank trims the premium, it does not prove the put is cheap. 30 to 50 is acceptable if the setup is strong. Above 50 is elevated versus its range, so use a spread or wait. And use IV rank correctly. It is a reading on the stock, not on an individual strike. Same stock, 2 different dates. IV rank 65 before an event, avoid. IV rank 22 after volatility normalizes, and that is when you buy the minus 0.75 delta in the money strike. Managing the trade. Take profits. Our rule at 30 to 50%. Here is the worked exit. You bought the $155 put for $8, $800 total. The stock drops to $144 and the put marks around $12. And I say around because the exact value depends on time remaining and implied volatility. You sell to close for $1,200, a $400 profit, 50% realized. Never let a winner round trip back through break even. On the other side, the 50% stop. If the put halves to $400, close it. No averaging down on a losing option ever. And the time stop. No move your way by the halfway point or the final 14 days arriving. You close and redeploy. Defined exits protect capital and cut hope out of the process. When the thesis is intact but time or price has moved, you have 3 choices. Roll out, same strike, later expiry, pay a debit to buy the thesis more time. Roll down. After a big drop, sell in the money put and buy a lower strike, banking the difference. Or close and redeploy, because sometimes the best roll is no roll. Here is the roll down, and watch the accounting, because this is where sloppy traders fool themselves. The stock crashes from $150 to $135. You sell your $155 put for $22. You paid $8. So that is a realized profit of $1,400 locked in. Now you buy a $135 put at the money 60 days out for $5, which is $500. The roll itself nets you a $1,700 credit. Add it up from the original entry, $800 out, $2,200 in, $500 out, and your cumulative cash flow is plus $900, with the new $500 put still open on the books. Here the distinction: your realized profit is the $1,400 on the closed put. The $900 is cash flow, not profit, because $500 of your money is back at risk in the new position. You paid yourself and stayed in the trade at a lower strike with a new expiry and a new premium at risk. 6 mistakes to avoid. Cheap, short-dated, out-of-the-money puts. Weekly 10-cent puts are gambling, very low delta, and theta destroys them in days. Buying into a binary event. Implied volatility peaks before earnings, and the post-event crush can halve the put, even when the stock drops. Ignoring implied volatility. Buying above IV rank 50 is overpaying for insurance, so check IV rank first. Averaging down a loser. A put losing to a rally and to decay does not get more of your capital that compounds the loss. Holding to expiration on hope. If it is out of the money in the final 2 weeks, sell for whatever remains. And no defined exit plan. Profit target, loss stop, time stop, all set before entry. No plan is gambling. A quick glossary so the language is second nature. Long put, strike price, the net debit, intrinsic value, time decay or theta, implied volatility, delta, and break even. Pause here if you want to lock these in. As the buyer, remember the 2 that matter most. Theta works against you. Every day costs money. And intrinsic value is your friend. Strike minus stock price, never below $0, and it is the part of the put that does not decay. So, master the long put. You profit from declines or insure a portfolio with risk capped at the debit. You buy time and intrinsic value, 60 to 90 days, in the money, entered in low volatility, and you exit by plan. Our plan, profits at 30 to 50%, losses at 50%, sell to close before expiry. That is the discipline. Educate, discipline, execute. If this helped, here is where to go next. Watch the long call, the bullish counterpart. Same defined risk, opposite direction, and together they are the directional toolkit. Go deeper in the Overlord's Covered Call playbook, the full course, 3 stages, 9 steps, and use code YT100 for $100 off. And stay current with the weekly market update every Sunday, the scoreboard, the regime map, and 1 rule for the week, graded in public. Thank you and good luck with your trading. I'm the Options Overlord. Educate, discipline, execute.